Happy Monday, everybody. It's Paul Olbrantz with This Week in Interest Rates. I got to tell you, this weekend was absolutely hectic. What are you guys doing out there? Everyone's starting to look at houses. I think we had 3 contracts, maybe 4 contracts come over the weekend. It's been huge. And, it's really not a surprise, especially if you watched my 2026 forecast. And there was one segment where it talked about when interest rates hit at or below about a 6.625, buyer activity really starts to spark. And that's truly what we're seeing right now. So what we're going to talk about today, we're going to talk about interest rates. We are going to talk a little bit about buy now or wait. We're going to talk about forecasting of where the 30-year fixed rates are expected to be. We're going to talk a little bit about Jerome Powell and who he has appointed, or at least going through the process for the Fed, what that means to you. And what else we got here? We're going to talk about what's going to happen this week in interest rates. And at the very end, for some of you people that are a little bit of nerds like I am, we're going to take a look at what the actual bond market is doing and how it can impact you and your home search as it relates to interest rates, because we don't like surprises here. I don't like surprises. Unless it's a birthday, then I love surprises. Let's go ahead and let's start at today's rates. You're going to see that it's very similar to last week. Very little happened last week. We are entering the week floating. However, I want to put cautiously floating because we have a big week in reports that can really influence 30-year fixed rates. But take a look at interest rates right now. VA's at a 5.25, FHA 5.375, and then we also have conventional and jumbo at about 5.75, 5.625. Now, notice we're still showing rates with 1 point. This market, it's starting to change seasons. For those of you who saw my webinar, we're starting to change seasons where, we're not going to start being able to see sellers pay for closing costs. I think there's still a lot out there you can do, but we're starting to make that transition. So right now you can get a rate that is, I guess I'm going to spoil alert a little bit here, that is well below where rates are projected to go just in 2026, just by having where we're at with the sellers and having the seller pay for it. It's pretty amazing. So buy now or wait. This was a 20-minute breakdown I did on Friday live on YouTube. And, really there's a few things we talked about. We talked about seasons of real estate. That is so important. If you want to be a successful investor as it relates to real estate, you have to understand patterns. You have to understand seasons. There's seasons in the world. There's seasons in life. There's seasons in real estate. And the moment you know what those seasons are and where the play is and how you can benefit from it, the more successful that you're going to be. But let's talk about interest rates. So I'm going to give you the spoiler alert here. This is where 30-year fixed rates are expected to go in 2026. I mean, Fannie Mae all the way down to MBA, the range is going to be about 5.7 to about 5.7 to about all the way up to 6.4. Now, I want to show something real quick. Just bring it back here. Look where the rates are at today. They're well below where they're projected to be in some cases. Now, this is with 1 point. So if you had a jumbo, it'd be at a 6.125, maybe even a 6%. So the lowest it could put that's being projected to go right now is 5.7%. Now, keep in mind, it's not a linear decline, meaning, rates today at 6%, let's just make it easy, right? And it's going to go down to 5.7, which is the best with the best projection. It's not linear like that. What's going to happen? It's going to shoot up. It's going to shoot down. It's going to shoot up. It's going to shoot down. And so it's really hard to time to get the best interest rate. But just know that, especially if you're looking for homes, you want to pay attention to where rates are at, this video every Monday, because once you get in a contract, we can only lock it where the market's at during that time. So it's really important to understand and how that can impact your home search. Let's go ahead and take a look at Case-Shiller last week. came out with home appreciation. You guys, values are, taking out the seasonal adjustments from December and the holidays and Thanksgiving. Month over month nationally, it's up 0.4%. The 20, city index is 0.5%. But if we want to get more local, I would say on average in the Bay Area, home values are going to appreciate anywhere from 5 to 6% over the 2026, especially if interest rates continue their decline and sparks more buyer activity. It's the supply versus demand. That's just what it is. I lost my track on that. Oh, there it is. If you want a specific town or county and to show the appreciation, let me know. I'd be happy to send that out to you. Just send me an email, give me a call. We'll make this super easy for you. Okay, so who is this gentleman and how is he going to impact your home buying? So this is Kevin Warsh. Did I say that right? Warsh? Yeah, Warsh. Kevin Warsh. This is who Trump is appointing to replace Jerome Powell. He still needs to be approved through, I believe, the Senate. But how he is going to impact you is he's been very critical of the Feds, of Jerome not lowering interest rates. Now, just remember, the Feds, they control short-term rates. How it impacts 30-year fixed rates is the bond traders are looking to the Fed to see where they're thinking inflationary pressures are going to go. Inflation is the kryptonite to 30-year fixed rates. So if the Feds aren't lowering interest rates, there's a fear of inflation. And so that's what's going to hold up 30-year fixed rates. But once they start continuing to cut short-term rates, that's going to give notice to the bond traders that, hey, inflation is under control, and that is going to put bond prices up, which is going to lower interest rates. So it's really interesting to see how all this works hand in hand here. But make no mistake, I'll never forget this. My college professor said that the most powerful person in the world is the federal chairman. So there you go. There it is. That's one thing I remember from college. All right, this week in rates. This is what's going to happen this week. Remember, there's the inflation, the Feds, the inflation, and employment. Those are the three legs of this rate stool. And this week is a big week when it comes to employment. On Tuesday, tomorrow, we have JOLTS. We have Wednesday, ADP, job cuts and job claims on Thursday. And Friday, we have BLS job reports. These are all things that can increase, that can impact interest rates. And if there is any big adjustments, I'll send something out to you. But these are the things to be aware of. Just as a summary, if employment is stronger than expected, that's going to be inflationary and push interest rates up. If numbers come out worse than expected, that's deflationary. And that is something that could definitely help the bond market or 30-year fixed rate. So if we're not working together, we definitely should. Here's a QR code to my calendar. We do what's called a hopes and dreams. Even if you're not ready to buy a home yet, it really doesn't matter. Let's put together a plan for you and your family. So when you are ready, we're going to put you in a position to save on interest rate. We're going to answer all your questions. Like, you need the map, and I can get you the map. You just got to tell me where you want to go. All right, lastly, let's for all those that want to take a look at the bond chart. So let me remove this and bring the bond chart up. So this, I'm going to hide me here. So this is the actual bond chart as it relates to 30-year fixed rates here. So, when we take a look here, so it's an indirect relationship. So here is, this was back on January 9th. This is where rates were the best. And as the bond price goes down, interest rates go up. So it's an indirect relationship. We call these Fibonacci levels or channels, and they trade in these levels. So in order to break through a Fibonacci level, to to go high for rates to improve, this is going to assume, this is the exception, not the rule. So what's going to project interest rates higher is negative employment news this week, which could take this bond number up to the next Fibonacci level and put this back into this trading range, or this is what makes me nervous. This is the 10-year treasury here. There is a lot of room for this 10-year treasury to go up here. And typically 30-year fixed rates move in directly with the 10-year treasury. So as this price goes up, so would interest rates. So be mindful this week. We're going to keep a close eye on these charts here, especially when the news comes out. So if there's anything that comes out that's unexpected that can impact your buying power, I will make sure to send out an alert. With that, hope you have a great weekend. It's great week. It's Paul O'Brien's Clear to Close Brokers. See you